Takes us to our talk of the tape. Can this market continue its levitation and rotation act for much longer? And how high are the stakes now riding on the Fed's decision and policy message coming in less than 24 hours? Let's turn to Ann Sonders, Chief Investment Strategist at Charles Schwab, for some thoughts on all that. Ann, it's good to see you.
How are you?
All right. So you've been noting the level of kind of churn and leadership shifts underneath the surface of the index. You know, the S&P 500, it's kind of flattened out and slowed down a little bit this month, but it has kept aloft near these highs. What's the message you're pulling out of that action?
Well, the real churn and the most significant rotation has occurred within the NASDAQ. So the NASDAQ is trading, near all-time highs, and at the index level has had no more than a 3% drawdown at any point this year. But the average member maximum drawdown this year within the NASDAQ has been negative 26%. Obviously, that's bear market level declines. And the recent breakouts that you've seen, and this is across indexes, not just the NASDAQ, the strongest breadth, at least relative to 50-day moving average, has been in materials and financials and energy. So I think all else equal, it's not a bad thing to see this rotation and churn happening under the surface, sort of a corrective process without the indexes coming down all at once. But I think it is sending a message about economic resilience, and that's why there's more of a cyclical bias to what has been working.
For sure. I mean, in some ways, I guess it is sort of a hallmark of a bull market that instead of, nasty sharp pullbacks, you do get some of this rotation. And I guess the question is how much interest rates are acting to restrain any of the economic activity or the market, because it seems as if we've managed to deal with this lift in bond yields as well as a repricing of what the Fed might do. And both the economy and the markets have taken it in stride so far.
Yeah, in terms of the economy, we know there are some buffers. Corporations have, in many cases, particularly the large corporations, have termed out debt. Many of the mega cap companies earn more interest on their cash and they pay interest on their debt. That's not the same thing if you go down the cap spectrum, certainly into the zombie world. And I think that has manifested itself in stock market behavior, too, whereas last year, particularly the second half of last year, there was a direct and almost perfect inverse relationship between bond yields, longer-term bond yields, and stock prices. It's a little more nuanced this year. You're still seeing it with an index like the Russell 2000, less so with a larger cap index like the S&P. So that relationship is there. It's just not as clear-cut as it was in the latter part of last year.
For sure. And I guess the other question is the recent uptick in some inflation measures and how the Fed might characterize or deal with that, or maybe, who knows, look past it or make much of it tomorrow, and whether that's either a concern or is that just, part of this backdrop of a relatively high nominal GDP growth economy.
Well, obviously, we've been through this adjustment process throughout the course of this year, going from at the start of the year an expectation of a March start to cuts and 6 to 7 cuts. And that's consistently been priced out, courtesy of not just pushback on the part of the Fed, but the data itself that was not supportive of that. And now it's even a coin flip for June, very low probabilities in May. And I think the dots plot could show that we've taken, yet another cut out of what have been 3 per that dot. So the question, though, is at what point does it hit the market, given we've had this market resilience? I think ultimately it's not just about the Fed reaction function, but the sustainability of the economic growth profile. I think an environment, sort of worst case scenario, not that this is what we're anticipating, but worst case scenario would be a continued uptick on the inflation side of things, weakness in economic growth, sort of strangleholding the Fed and keeping them in this pause mode for longer. But I think we'll get at least a little more color on that at the upcoming Fed meeting.